This is TreppWire Week in Review for week ending September 2nd, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, markets reacted to the Fed's resolve in Chair Powell's warning that the landing for the economy may be a hard one. And in economic news, more signs that the housing market has softened. And retail earnings flash warning signs, but other economic data suggest resilience. Manufacturing held steady last month, job openings rose in July, and consumer sentiment increased. Manus, we're heading into the last weekend of the summer. What do we make of the latest round of news?
Well, Martha, you put out a couple of real positive notes at the end of that opening, but I think my feeling this week was akin to the 1958 rock and roll classic, Ain't No Cure for the Summertime Blues. There was a lot more negative than positive over the last week. And by the way, that was a B-side. You know that? That wasn't even the A side of that 45. It was a B-side. Must be one of the greatest B-sides ever done. Anyway, going back to the issue at hand, the things that we saw this week were, in my view, not beneficial to the capital markets, not beneficial to commercial real estate in general, with a couple of exceptions. We started out last week with Jerome Powell in Jackson Hole pouring cold water on the idea that we could spike interest rates, get inflation under control, and then start resuming interest rate cuts very shortly thereafter. He gave a very sparse 10-minute explanation of where his head is. People were expecting a longer set of remarks. He said that this is going to be a long and painful process and that rates will have to remain plateaued for considerably longer than the markets may think. Now, this week, that was followed up by the New York Fed president re-echoing those remarks and the San Francisco Fed president saying that interest rates should rise to about 4%. So that was a real chilling set of remarks coming out of the Fed over the last few days. The reaction was equally severe. Stocks fell for 5 consecutive days. That equaled the longest losing streak since February. The Dow, even though it rose today, Thursday, September 1st, thanks to a late day rally, it was off about 2,000 points over the course of 5 days. Stocks are now 50% back towards retracing their June lows. And interest rates are really, really higher at this point. The 2-year yield is now at 3.51%. It hasn't been that high since 2007. So 15 years since we've seen a 2-year that elevated. And the 10-year today rose another 11 basis points, and it's at 3.26%. Before that rise in interest rates on the 10-year, the 30-year residential fixed rate mortgage was just a hair under 6%. We can expect that to be over 6% again next week. So a lot of negative interest rate, Fed announcements and moves. I think it was a painful week. And on top of that, in the retail segment, just a boatload of firms lowering guidance over the last 2 weeks, right? We could run down the litany: Express, Target, Best Buy, Five Below, Dollar Tree, Walmart, Nordstrom, Kohl's, The Gap, Macy's. All of those firms are telling us that, it's not going to be smooth sailing for the rest of the year. So definitely a glass half empty week.
Yeah, it was interesting, Manus, to follow Powell's comments from Jackson Hole, Minneapolis. Fed president said that he felt like the shock in the stock market and the sell-off showed that, investors understand the central bank is serious about reducing inflation. So I don't know that we've necessarily had that sentiment to this point, because as hawkish as they've been coming out of some of their meetings, the market has sometimes rallied or actually done the opposite of what conventional wisdom would assume. So it was interesting to see the market react in such a negative way after the comments from Powell. A couple of other anecdotes for this week. The CoreLogic Case-Shiller Index actually slowed. So we've talked about this on the podcast several times. 20-city house price index, the rise slowed to 18.6% year over year for June, which was down from 20.5% in the previous month, the lowest increase in the last 2 years. And then if you read a little bit further into the report, CoreLogic effectively says at the national level, there are several identifiable markets that have seen notable waning of home prices. That would include Seattle, some California coastal metros, Portland and Denver. So it's really interesting to see some of that data starting to show a dramatic slowdown in terms of activity and price appreciation. And then you hit on a little bit the 30-year fixed rate. Freddie Mac has the average 30-year fixed rate right now at 5.66%. But I saw some stuff today where they're quoting 30-year mortgages about 6.25%. So not great news. If you compare that to the same time last year, rates were, sub 3. Another interesting nugget, we're going to talk a little bit about housing here in a moment, but Redfin did a study that said 16% of all sales contracts were canceled in July, which is the highest since March or April of 2020. So again, storm clouds on the horizon. Labor market's interesting. Job openings rose to 11.2 million in July. That was the first increase in 4 months. Job openings had been at about 11 million in June, so about a $200,000 increase. But if you dig a little deeper, the number of quits, so the resignation, is still at record numbers. So 4.2 million folks quit their jobs in July. If you look at pre-pandemic numbers for that statistic, it was around 3 million per month. So still significant turbulence in the job market. And just kind of in conclusion there's almost 2 open jobs for every unemployed person. So the labor market is still super intense. And then you hit on a lot of the retail earnings. Something else that was noteworthy this week, Snapchat's parent company, Snap, planning to lay off about 20% of its more than 6,400 employees. And we've talked a little bit about some of these tech companies laying people off over the last couple of months. And I think it shows, how dependent some of these folks are on advertising revenue or a single stream of income, that when the market gets a little choppy, they have to make some pretty dramatic cuts to their workforce. There's no gradual trying to reduce headcount. They're basically 10 to 20% is what we've been seeing, just cut overnight. And so in this instance, about 6,400 people are going to lose their jobs. So a lot of interesting stuff going on in the markets. It'll be interesting to see how, the next couple of weeks play out based on what we saw this week.
Yeah, a couple of comments on the residential side. Those price appreciation numbers tend to lag, right? We're already in September and those numbers are as of June. We didn't see that really shocking CPI number until mid-June. So my guess is that we'll see more leveling off or declining of that growth rate 3 months from now. I think that these givebacks that we're talking about, contracts being canceled and so forth, will definitely have a material impact on that going forward. The other thing I saw this morning on Squawk Box was, and I wish I could give credit where it's due because I didn't notice who was putting this research out, but they talked about rental growth in multifamily year over year between the summer of 2021 and 2022. And we've all talked about this in the past, how earlier this year, the numbers were shockingly high. I was blown away by just how high they were. I think the average they touted today was 14.4% across the markets that they cover. And they singled out 3 or 4 markets for which rents were up more than 20%. One was Cincinnati, one was Seattle, and I forget what the third was. But just extraordinary growth. And when you think about that, it's hard to imagine that the dip we're getting, the tailwind we're getting from the drop in energy prices since June will be more than enough to offset what we're seeing in rental increases and food increases based on some of the recent data. We'll see. We'll know this by the middle of September when that next CPI number comes out.
So just a couple observations, Manus. It seems that the stock market has gotten Powell's message loud and clear. I'm not sure the consumer has, though. If you looked at some of the data that was put out this week, Open Table showed that dining demand is still holding very steady, and reservations in the last month have risen about 10% compared to 21. And additionally, the last minute summer cruise bookings are nearly up 10% over pre-pandemic levels, which is really a shocking statistic. And Expedia is also reporting that searches for fall bookings are up 40% from last year. So consumers may not be spending their money at some of the retailers, but they are spending it on going out to eat and going on trips.
They certainly are. I think the interesting thing about that Open Table is there were a few cities that were real laggards in there, and those laggards tended to be those cities with real quality of life issues. for people in New York, I think New York was one of the laggards, between really muted numbers when you look at the Castle data return to office index, and you see some of the headlines on the news of crime and so forth. It's understandable on why those numbers would be deflated in some of those quality of life cities. But going to your point before, Martha, you said that the stock market seemed to get it this week, and Lonnie had said before, until now, the stock market and stock investors were maybe running counterintuitively to what you would have thought, right? Rising rates, but stock prices surged in July and early August. I kind of find it akin to when your parents keep giving you threats as a kid, and they say, we're going to take away the credit card, or we're not going to let you use the car, or we're really going to adhere to this, 11 p.m. curfew. And you just kind of laugh it off until that one day comes when you realize that you're at the store and the credit card's not working and you can't take the car out anymore, right? And I think that in July and early August, the stock world was in full belief that the Fed would go wobbly and that they would run out of conviction for rate hikes sooner rather than later. And I think Powell used that Friday speech, and the Fed presidents this week used their airtime to say, we're not kidding this time, right? Not only are we taking the car away and cutting down on the credit card, right? We're sending you to your room without dinner and no TV for a month, right? I think that was the message they were trying to give. And I think the stock market heard it loud and clear this week. The only thing missing out of that was, I'm sure Lonnie was one of those guys who had his mouth washed out with soap. They didn't wash out Lonnie's mouth with soap this week, but they gave him all the rest of the lockdown.
I will say my mom just took one time. The Irish Spring smells really good, tastes really bad.
And there were a couple other notes that were on the bearish side, specifically around housing.
So Goldman Sachs released a paper this week. The title of it, The Housing Downturn Further to Fall, kind of giving you a preview into what they're anticipating. And the numbers are pretty significant. They're forecasting activity across the U.S. housing market is going to end down across the board in 22, effectively significant declines across new home sales. They're estimating about a 22% drop, 17% drop in existing home sales, and then housing GDP about a 9% drop. So if that actually happens, it's going to definitely be a bottoming out for the housing downturn. However, for 2024, they expect activity to begin to rebound. So some of these things, I think we're all really close to this in what we do every day for a living. And the headlines can be scary, but if you think about it from a longer term horizon or perspective, housing prices specifically have been going through the roof for some time with really no correction. So, even if there's a 22% drop in new home sales, you're still going to be at a higher price point than what you were 5 years ago, even if there's a significant drop, because appreciation has been so high. Bringing it to Texas, where I'm a little more familiar, the Texas Tribune had some story this week that basically outlined there's more houses on the market for sale in July than there has been any time since late 2020. And home sales have declined across the major metros in the state. We're starting to see sellers bringing back price cuts to entice buyers. I've also seen higher commissions being paid if you get under contract and close within a certain time frame. We're starting to see that pendulum swing back to be a buyer's market, where for the last several years it's been 100% a seller's market pretty much across the board.
And one last bearish comment. You've probably seen major publications had been quoting investor Jeremy Grantham, who's issuing a warning to prepare for an epic finale. He's saying that we're going to have a Superbubble bust across a number of assets that are overvalued. He says between COVID in China, war in Europe, food and energy crisis, record fiscal tightening, and more, the outlook is grimmer than could have been foreseen just a few months ago.
It's interesting when you read that headline, you wonder what the Superbubble means. When I first started looking at it, I thought he thinks we have more of a bubble to go. And then when it will burst, it'll be an epic burst. But it sounds like when you read into it that he thinks the bubble's already here and there's nowhere to go but down. Although it was a little bit hard to quite get your arms around that. I think of all the things that you rattled off, Martha, I think the one that really stands out for me that is flying under radar for people in the United States right now is that food and energy cost in Europe situation, right? That you see these headlines where people are paying 2, 3, 4 times what they were paying in the past for energy in Germany. We've already talked before about the rationing of hot water and so forth. And this is the summer, right? When that temperature in Germany gets to be 25 degrees Fahrenheit, right, or lower, and people need to keep their home warm, there could be a real reckoning there, and that really does concern me. We've talked about this before. Expectations for crop production, especially corn this year, are muted, and you combine higher energy costs with higher food costs, that could really be the combination that pulls the rug out of this stock market, and correspondingly values of commercial real estate, residential real estate, and everything else.
So with all that, let's go into the CMBS delinquency rate, which is, I think, good news.
It is good news in a week that has been very turbulent. The CMBS market continues to be kind of a bastion of consistency, not in every part of it. In the new issuance side, it has been a little bit like a clogged artery compared to very early this year when the market was humming along. Spreads are wider, lending conditions are tighter, but the market is functioning. But on the delinquency side, it really has been a model of real consistency, a positive story month after month, and we'll get into some of those numbers. For the first time since before COVID began, since the spring of 2020, the overall delinquency rate went below 3%. August 22, the overall number was 2.98%. That's our headline number. When you look at only loans that were made after the great financial crisis, some of our headline number includes legacy loans that are still residing in purgatory, waiting to be resolved. For stuff that was done after the great financial crisis, the percentage of loans 30 or more days delinquent, 2.68%. On the headline number, as I mentioned, we cracked 3% for the first time in more than 2 years. Only 6 months ago, we were still above 4%, and a year ago, we were above 6%. So this reduction has been steep and consistent. It's been nice to see. We saw a very big drop this month in hotel delinquencies once again. Distress continues to be squeezed out of the system there. And I would add that I guess nobody should be shocked that this is where we are. And I'll get into this thesis in a moment. We did write this out this morning in TreppWire, but the areas of commercial real estate that were hammered in 20 and 21 continue to improve, right? Hotels, we've seen the delinquency rate cut by 75% in the hotel space. We've seen it drop by about 2/3, let's say, in the retail space. Yes, the malls are still messy and unresolved, but everything else in the retail space has seen a squeezing out of distress, and that continues to happen month after month. In fact, we've seen the delinquency rate drop now 24 out of the last 26 months. The one problem that people are expecting is office, but because of the office problem being so long to play out, because people are in 5 and 10-year leases, it would be irrational to expect a huge blip in office delinquencies over the course of 3 or 6 months. Offices are going to be a problem episodically, but this is going to be something which the scale of delinquencies in the office space goes up tick, 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 tick for about 5 years. We're not going to see this racing delinquency rate like we saw in COVID or like we saw during the great financial crisis. It just can't happen without these firms that are tenants having credit issues.
Yeah, I think a couple of the takeaways for me, Manus, you hit on a few of them. One thing that was interesting is the industrial delinquency rate actually ticked up a little bit. Still, I mean, very negligible, 51 basis points. It did show some signs of increase. On the office sector, there was down 12 basis points month over month. Your point is valid in terms of the staggered lease terms. I do still think we're going to start seeing some of these challenges upon maturity, not necessarily delinquency over the term or delinquency during the term, where I think you're going to start seeing some challenges and potentially some holdovers for these properties that can't refinance. And so it is kind of interesting, though, because we've we've given a bunch of statistics. We've talked about downsizing or right sizing, whatever you want to call it, in the office sector. And even as resilient as it should be based on the lease structure and the multi-tenant nature of those assets, to see this rate, at $1.50 is still really shocking to me, given where we're at in the cycle. So I think it'll be very interesting just to kind of keep an eye on that. The one difference between office and the retail sector, as you pointed out, the mall properties are still largely unresolved. And that was pretty much every BNC mall without exception. In the office sector, you're still going to have some properties that are going to perform well. And so it's good to see 24 to 26 months, as you mentioned, with positive news. I think this is definitely a bright spot. And even with all of the turmoil and all of the headlines that we've talked about, the property market just continues to show how resilient it is.
Yeah, Steve Cuozzo of the New York Post had a good piece this week. And it reflected, I think, what our sentiment is, I think, among the four of us about the office market in general. But he did a really, excellent job articulating it. And he talked about that KPMG move that we spoke about last week, right? Reducing their size by 40 or 50%, moving to a bright, shiny new space in Hudson Yards, and giving up on a place where they've been 20 years, which is kind of dated. And his arc, and it's consistent with our arc, is that that's what's going to be the case. No matter what the city is, whether it's, New York, Chicago, Boston, San Francisco, people are going to gravitate towards the new, fresher, better stuff. And it's that older stuff that will really find its way into the new purgatory, 2 years from now.
So let's dig into property specific news. Why don't we start with hotel?
Thanks, Martha. I don't have a lot in the hotel segment, but I did have one I wanted to point out. We wrote about this in TreppWire. It's a story about the Westin Portland, which is a $51.5 million loan that backs a 2015 CMBS deal. The hotel itself is a 205-key full-service hotel at 750 Southwest Alder Street in Portland. The last payment on this loan was made in March 2020. Even before COVID, the property was struggling with DSCR under 1.0. That started in 2017. What jumped out at me when looking at this particular story was August special servicer comments for this loan said that March 2022 occupancy was still only 26% for that particular hotel. ADR and RevPAR were $125 and $33 respectively. So really distressed numbers. And it goes to this thesis of mine. And Portland, has had a lot of issues with them closing down the courthouse there, conservatives and liberals rioting against each other in the street. It's been going on for several years now. And it underscores the thesis we have, which is there will be losers even in this robust recovery for the hotel market, that these quality of life issues, whether they're Seattle, San Francisco, New York, Chicago, right, or in this case, Portland, will weigh on these properties. And there's probably not a straight line out of this distress without a reckoning that involves resetting the pricing of hotels in most of these markets. In New York, it's already reset, right? We've gone from about $450 a room for a kind of a middle of the road Hyatt or Hilton in that city to about $200,000 per key, right, over the last 2 or 3 years. And I think we haven't seen a lot of hotels clear in Seattle or Portland, but I do think they will. And when they do, it'll be that 50% discount to what we've been used to.
Yeah, just anecdotally, we've had a couple of conference events out in the Portland area the last couple of years. And some of our team was actually out there about 3 weeks ago when they came back. I wasn't with them on the trip, but I'm always interested to kind of get a feel for what the local economy feels like and how the property markets appear to be performing. And without fail, the team that was out there said that the difference in commerce in terms of people being on the streets, buildings being boarded up now compared to 2 years ago was significant. That basically Portland as a city has shut down. There's so many ground floor retail and office buildings that are completely boarded. You mentioned the courthouse. And so, it's shocking when you look at the numbers here, 26% occupancy, $33 RevPAR. But when, people aren't traveling there and the city shut down, these are some of those downstream impacts. So I think it'll be interesting to see when you're saying a 50% repricing, Manus, it may actually be more dramatic than that in areas like this where, with civil unrest and, not really sure, how things are going to come back there, what the timetable would be for them to even reopen the city. Investors looking at this market have to have a long-term strategy in place, because I don't foresee something, ownership and new operations is not going to cure these challenges. These properties suffer from an external obsolescence that's bigger than the individual investor. And so that can sometimes drive pricing down significantly more than what you would think.
This whole talk about Portland has reminded me of something. It comes out of left field, but we're heading into Labor Day. We're a little bit punchy from the dog days of August. And so I'll throw it out there. The most extraordinary athletic feat I ever saw was not on a basketball court or a hockey rink, but I was taking the old Eastern shuttle from New York to Boston for a meeting. And back then, NBA teams had to fly coach. And if you remember, the shuttle back then had no first class. Every seat was the same size. And on my flight that day was the Portland Trailblazers. And I saw this guy, Kevin Duckworth, 7'2", 275, I would guess, fold himself into a coach seat on that shuttle to Boston. It was David Blaine couldn't do that. I'm telling you, it was an extraordinary athletic feat. And the funny thing is, there must have been 7 guys that were over 6'10" on that. It was amazing, I got to say.
How did he get out?
I don't know. I hustled out of there quick. Somebody probably lost an eye.
So let's pivot to office. We've got a number of stories there. You probably saw the stories this week. Goldman and JP Morgan want their employees back in the office 5 days a week. Goldman's latest memo says workers have to be back after Labor Day for 5 days. They've lifted all their COVID protocols and the jig is up. You got to come back.
I have a cynical ploy or a cynical remark about that. Goldman said 2 years ago that they were going to, halt layoffs and halt their staff reductions that they would do annually. I think this is a way of paring your employee count without paying people severance, right? They're counting on 10 or 15% of the people saying, we're not coming back. And they'll say, that's great. We were looking to, reduce our staff by about 10% given the state of the economy. And you've helped us get there. So that's Manus the cynic on a late summer Thursday afternoon, pre-Cabernet.
I was thinking the same thing, man. It's like, they've had teams go in and actually do that analysis to say, if we come back, permanent 3 days a week, 4 days a week, 5 days a week, here's what the attrition is going to be. And to your point, that's a pretty quick way to get that catch up of attrition over the last couple of years, or maybe they haven't had it. I will say though, if they're successful with this, let's play it out and people actually don't walk and they do come back to the office. I would take this as a pretty strong indicator that you're going to start seeing a lot of other firms jump on the bandwagon, and maybe this work from home hybrid work week becomes something that starts to fade out and become a little less fashionable. So I think depending on where you sit on that conundrum, you probably have a lot of employees that are hoping this falls flat, because this ensures that they're going to continue to have that hybrid work schedule for the next couple of years. You have others that want to be in the office that's hoping this is very successful, because this will probably be a catalyst for other firms to say, hey, guess what? We're ripping the Band-Aid off too, and everyone has to come back to the office.
I think this works as long as you have a labor market that's extremely tight. Once employers have an upper hand and there are layoffs or other changes, then you'll see the employee change their mind and say, maybe I should go back into the office and be seen more often.
Yeah, I mean, one thing that I was talking to one of our listeners the other day, and I thought one thing that the city should do right now is put some skin in the game here and allow employers to, we have this system in New York where you can get vouchers for your train tickets, but it's very kludgy, right? They can give you a voucher and then you could take some of your money with post-tax dollars and buy train tickets or pre-tax dollars, right, to make it more affordable. If I were the city of New York, I would say, we're going to waive all of that. You can give your employees a tax-free benefit of up to $250 a month to cover their commuting costs as an incentive to get people back on those trains every single day, right? The system as it works right now, it's a nice little perk for people. You get, a cheaper train ticket as a result, but it's kludgy. It's kludgy. The accounting systems, the teams on your accounting staff has to kind of jump through hoops to make sure this works. Make it for 2 years. You could hand out these vouchers to everybody on the first day of the month, tax-free, right? Here it is, $200, go get your train ticket, period. End of story, no tax implications, get people back on the trains. Call it the Clancy rule.
We have something similar here in Texas that have been really successful with tax increment financing districts, where local municipalities establish a TIF district. The building's owners pay a certain percentage of additional property tax, but it helps offset or subsidize some of the attractiveness of downtown. So like as an example, Fort Worth, Texas has pretty strong TIF funds that they use to subsidize parking in the city after 5 o'clock during the week and all the time on the weekend. So if you come into the city, you don't pay for parking after 5 or on the weekends. And, to your point, it takes away that one additional burden of maybe bringing people back to the city and makes it a little more palatable. So I think that's actually something that should be considered and will probably be, pretty widely utilized.
Are you listening, Mayor Adams?
That'd be interesting to know if he's a listener.
He might be one of those shadow listeners that never reaches out, but he's out there every Saturday morning on his Peloton, listening in, trying to get his finger on the pulse of the commercial real estate market. Running through some office stories here, run through several very quickly. This came out yesterday. Invesco is reducing its space, but extending its lease at a big Houston office. The property at hand is the Greenway Plaza in Houston. This backs a $465 million loan. That particular loan missed its maturity date in June. It's in CMBS purgatory right now, one of the first office loans to be in that category. The borrower is looking to get a more substantial extension. They've gotten 2 forbearances to push the maturity date out. Right now, I think it's till December, but they're looking for something more substantial. Invesco is the top tenant at 11 Greenway, which is the second largest building in that complex. The complex totals 4.5 million square feet. Invesco has been there for 20 years. They have about 370,000 square feet, cutting that to 180. And if people were looking for like a back of the envelope, how do I underwrite new loans for expiring leases? I think that 50% number seems to be the sweet spot. Everything we seem to report on seems to be 40, 50, or 60% reduction in the space. And if I'm somebody who's saying, okay, we got this lease ending in 2024, we're looking at buying this building, market rents are market rents. You plug in what you think the market will bear. But I think for any of these guys with 200,000 square feet and up, I think the assumption has to be a 50% reduction.
Yeah, it's interesting. We've talked about the underlying fundamentals that have been used to underwrite deals are changing in real time. And I think you've hit it on the head here, where the metric used to be, you look at your lease rollover schedule, you assign a renewal probability to the lease, and then you go about underwriting it. Now, in addition to assigning a renewal probability, you have to assign some sort of right sizing, downsizing component as well. So there's another factor that has to be accounted for, because there's been too many of these where there's been significant reduction in space. And in this example, they have to consider this a win. Even though they're reducing their footprint by 50%, they're signing an additional 10-year lease. And the fact that they're, past maturity on the loan, like, this is not ideal, but this is still considered a very positive story for the operators there at Greenway Plaza.
Right. It certainly beats the alternative, which is 100% vacancy and moving to some other location. A few other things that we saw this week: an uptick in lease terminations for CMBS investors or your property owners, or I should say lenders in general. Always good to really keep on top of which of your tenants have lease expirations, or if you're a lender, on the property, is your lease going to 2030 or is it a 2025 lease termination option? In Rochester, New York, there's a $42 million loan on Alex Park South. This month, the second largest tenant, which is MVP Healthcare, 33% of the space, they announced that they would be terminating their lease. The lease was supposed to end in 2028. That termination will now kick in 2023. So really changes the dynamic for that particular property. We saw a similar thing at Granite 190, which is an office in Richardson, Texas. There, United Healthcare is the top tenant with 170,000 square feet, 56% of the space. Their lease ends in June of 2023. The firm has announced, this is not a termination, this is a relinquishing, that they're going to relinquish about 60% of the square footage. So there's a lot of stories like this going on right now that bear watching. And it's not a time, if you're a lender or a property owner or a CMBS investor, to kind of sleep on these things. They can change the dynamic of a credit very quickly. We talk about that property in Chicago where 70% of the tenant base is made up of Boston Consulting or Kirkland and Ellis, and Kirkland and Ellis has already terminated that lease, right? And it changes the duration of that rent roll from maybe 7 years down to 2.5 years. So in a market that is likely to be challenged for the next couple of years, certainly something to keep an eye on.
Yeah, these are definitely examples of some of the nuanced components of leasing space. So lease termination options, renewal options, lease space givebacks, those are additional terms that are added to a standard lease. Just like rent steps, traditionally you've seen maybe a 3% increase, 3% or inflation, whichever is higher. And those have been seen as kind of anecdotal components of the lease term, except when inflation goes to, what it's been lately. So I think the termination option is something you'll start seeing property owners be a lot more selective in terms of how they administer those in their leases, because to your point, Manus, if you have a large scale tenant that represents 30 or 40% of your, gross leasable area, have the right to cancel their lease 5 years earlier, that can really cause some unintended consequences for you as the operator. So these are kind of for those of us that are data nerds and in the weeds of this stuff, these are the nuanced things that really make this time in the market super dynamic, because things that you traditionally would view as kind of toss away or throw in components or language to the lease term really are starting to rear their head.
We did see two positive stories this week that office demand has not gone to zero, at least on the equity side. One of the big stories this week, Workspace Property Trust has agreed to pay $1.1 billion for 53 mostly suburban Class A offices from Griffin Realty Trust. Portfolio is spread across the U.S. and totals more than 8 million square feet. I say mostly suburban office. I do think that there's some industrial/office flex in the acquisition as well, but it is mostly office. So a big, vote of confidence. Workspace is jumping in, thinking there's opportunity there. The Griffin portfolios actually are located in CMBS, and those should be paid off with yield maintenance at some point. And then just coming out today, this comes from Tristan Navera of the Washington Business Journal. Boston Properties has sold 601 Mass Avenue for $531 million. He says that this is likely to be the top sale in DC for the year. And that would be no surprise when you consider that the price per square foot is over $1,100 per square foot. $531 million for a 480,000 square foot office. So signs of life in DC. Good for Boston Properties.
$1,100 a square foot is crazy stuff. Good for them.
And we will end with a multifamily hit.
Yeah, I got two of these, and I'm eager to hear Lonnie's take on this. For a long time, we had been saying that cap rates that we were seeing get done on multifamily sales were still in that 325, 350, 375. When we do these calculations, we're limited because in our data, normally we only have 2021 as the most recent NOI. So if something sells in June, we're using that sales price as the denominator. We're using 2021 NOI because it's the NOI that we have. We don't have projections for that. And we've been calculating cap rates off that. We started to see some things move north of 4. The first one, the Rivergate, is a luxury property in Woodbridge, Virginia. It's been acquired by Capital Square. The story comes from Multi-Housing News. The property sold for $98.5 million, which was about $10 million above where it sold in 2019. That sales price represented a 4.57% cap to trailing 12-month NOI. the trailing 12 months being through March 31st, 2022, but a 5.92% cap to 2021 NOI. While I dig up the other story, Lonnie, I'll let you think about what that means to you.
Yeah, so I actually pulled up some data from our system on this. This is a property that's in the Washington, Arlington, Alexandria MSA near DC. It's a mid-rise property. So we actually aggregate cap rate data on the trailing 12-month basis for these particular property sectors by MSA. So for this MSA, for this property type and class, we're looking at about a 4.02% cap rate on the trailing 12-month NOI. So this property at 4.78 actually comes in fairly significantly higher than what the market would indicate. If you compare that to nationwide multifamily mid-rise transactions, our trailing 12-month cap rate's about 3.7%. So you're talking about 100 basis points higher than the national average, about 75 basis points higher than the local MSA based on our data. So either we're seeing a correction in pricing as represented by the cap rate here, or this may actually indicate one of those rare opportunities in this market where there may be some upside potential on the rent side or something else that the property owner or the new owner thinks they're going to be able to capture by increasing rents or driving value upward.
I'll give you the other story. This will be coming out tomorrow morning's TreppWire. In the Westchester, New York suburb of New Rochelle, Halsted Station sold for $200 million. That story comes from YieldPro. The property is a 400 plus unit apartment in that town. It was acquired by a joint venture between Colsa Capital and Pacific Urban Investors. This particular property sold at a 4.46% cap to 2021 NOI. So, never does one deal or two deals make a market, right? Every deal is unique. But now we've seen a couple big deals here, almost 9 figures in one case and multiple 9 figures in another case, where we're seeing caps in that 4.5%. Is this where the market is now, Lonnie, given changes in interest rates, or does your gut tell you these are outliers?
Yeah, so I think it's, it maybe is a leading indicator that the markets have started to reset some. So, again, from, tracking the markets on Twitter and some of the news stories that have come across our desk, it does seem that the market on the buy side has been able to gain a little bit of traction in terms of retrading some of these assets for a more favorable price point. So I think this could be indicative of kind of what's to come. On the flip side, though, for every one of these stories where the cap rate or something indicates that maybe we're starting to see a turning of the tide, there's 4 or 5 stories that are still trading at those really low, historically low cap rates. So some perspective on this particular asset, our data would indicate about a 3.75% cap rate on the trailing 12-month NOI. So if you take this at face value, again, this property is trading at significantly higher than that. It'll be interesting to see, I think, as we've talked about on the office market, at length about maybe potentially tracking these right sizing or downsizing transactions. We're maybe getting to a point in the market where we could start tracking these cap rate moves and start seeing if there's some patterns across certain cities. So I do think geographically, you're going to see some differences. Both of these are not in the Sun Belt. So I think in the Sun Belt, the transactions that have had higher than expected cap rates or more like, mean reversion type of cap rates have been in markets outside of the Sun Belt. The Sun Belt still seems to be outperforming in that, basis. So I would say, hopeful maybe, I guess, that there's a cooling off, that maybe there's some of the market fundamentals being priced in here, interest rates, et cetera. So if you're interested in cap rate analysis, you're interested in getting some deeper dive on this type of stuff, like this is right in our wheelhouse. So if you're a listener and you want to know what's happening with cap rates in certain markets, reach out to us. This is something that we do every day. So love to share some of that information with you if that's of interest.
Yeah, to your point about it not being the Sun Belt, everything we see in the Sun Belt seems to be at a 50% premium to where this thing last sold in 2020 or 2019. And sometimes that 50% could be 70% or 80%. The interesting thing about these two, one in DC, one in New York, is the DC one was about, let's call it 12% appreciation to the 2019 price. And in New York, it was about a 14% increase to that 2020 price the last time it sold. So it is a situation where markets may not be cooling off at the same rate. And New York and Washington may be at the tip of that spear for where cap rates are starting to rise, and maybe other places in the industrial Midwest and other areas.
It's not been that long ago, Manus, and you and I would remember this, that if you could buy a property and exit at a 14% appreciation in value after 24-month hold, those were home run numbers. It's really interesting that now we're talking about, a 12% or a 14% appreciation over an 18 or 24-month hold is a cooling down of the market, and something that's noteworthy, because in a typical environment, those are things that when you're underwriting a deal that would have, over several cycles been considered super aggressive underwriting. So I think it just kind of speaks to where we are in the macro. But yeah, to your point, we're definitely going to start seeing some of these markets cool off. It just has to happen. And I think, as we talk about some of these, underwriting 2.0 or fundamentals 2.0 kind of changing, like net migration, other factors that maybe have not been as prevalent in terms of looking at drawing direct correlation to value, we're going to maybe start seeing some of those things actually play out. So some of these markets that have seen a large population shift, maybe they are at the peak and things are going to start cooling down some.
On to Shoutouts. Mark S. on LinkedIn sent out information about our CRE sentiment survey. And interestingly, a different Mark S. on LinkedIn commented that Trepp helps him stay in the know about CRE trends. He said, I learn at least 2 new things every week, don't we all? Daniel B. connected with Lonnie on LinkedIn, and we're going to send him some podcast gear. He says he loves listening to the weekly insights. Our own Prachi M gave Lonnie a shout out for last week's episode. In her thoughts on Twitter, tweeted at us, big fan of the TreppWire podcast.
You ever see guys like us, they start out in one little niche market, and the next thing you know, that they're making their own coffee, they have their own steak line, their own, form of wine, slippers, the whole thing. Do you think we're big enough for that yet? Can we start, Lonnie's brew? Can we have like the Lonnie K-Cups that come with the TreppWire podcast logo?
I think we're there.
We're there? What will we start with?
Lonnie is the bobblehead.
Yeah, I was going to say, it would maybe a bobblehead or a trading card, like instead of like me with a baseball cap and a bat over my shoulder, I'm like standing there with an Appraisal Institute textbook or something, pointing out the cap rate section. So yeah, I think that would be interesting, or some nerdy cooking apron, that looks like it doesn't fit. So I'm ready. My K-Cup though would have to be Monster infused. So it'd have to taste like a low carb Monster.
With that, we will close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment or a criticism, we take it all. Send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Guys, have a great long weekend. Thank you for listening and stay well.
All right.